Major news as Trump announced a summit with the Russian president. But how will it go? The answer might lie in economics and markets. Today, we're taking an in depth, data driven look at Russia's economy in 2025 and break down the key metrics shaping Russia's financial landscape to see what markets indicate about their future path. So, to start with, here are two labor market indicators. The unemployment rate running very low, it's declined from about 15%. In the late 90s, all the way down to 2.2%. This is about half of the headline unemployment rate in the US. Their labor force participation rate, exactly what it sounds like, is very similar to the US at about 63%. Here are the two main accounts that we always look at: the current account and the fiscal account. These are the two main accounts that you really need to evaluate to get a bearing before you start diving into the deeper realms of a country's economy. Here we're looking at current account, which is mainly the balance of trade, or put another way, the difference between how much value is being exported out of the country, sent to other countries, sent out of Russia and to other countries, versus how much is being imported in terms of value. So if you sell a lot of goods, if you sell more goods, the value of the goods you sell to the rest of the world is higher than the value of the goods that you buy from them. You run what's called a trade surplus. This, generally speaking, reflects as a current account surplus as well. Current account also includes a couple minor components like primary and secondary income, but mainly is the balance of trade. And Russia runs a trade surplus, a pretty significant one at that, of about 3% of GDP. Now, remember, we will see why it's important to adjust for GDP in a second, but 3% of GDP, this is really the number that matters. Now, this eases their deficit on the fiscal side. So they do run a slight fiscal deficit of about 1.7% of GDP. But the fact that they are able to run a current account surplus of 3% of GDP means that, clearly they have funding issues over the past couple years, things that they need to fund, and a huge amount of spending. Well, their fiscal deficit has remained relatively tame at just 1.7% of GDP. Part of the reason is that they are able to run a current account surplus of 3% of GDP, about double the fiscal deficit. And again, remember the current account, what that is referring to, more value is flowing into Russia than is flowing out. That is what the red line is telling you. And again, it's as a share of GDP, which is important to adjust for, as we'll see in a second. Just as a point of comparison, the US runs what's called a twin deficit, a current account deficit and a fiscal deficit. So unlike Russia, we run a current account deficit of about 6% of GDP, which is very significant. We also run a fiscal deficit much larger than Russia's at about 7% of US GDP. Now, this is why it's important to adjust for GDP. Here we're looking at the balance of trade, or their trade surplus, in US dollar terms on a quarterly basis, so every 3 months. We can see $35 billion US dollars in trade surplus per quarter. Now, this translates to a current account surplus. Again, we established this about 3% of Russian GDP, a current account surplus of 20 billion US dollars per quarter. So every 3 months. The reason that it's important to adjust for the size of the economy is just in dollar terms, the US current account deficit is 450 billion US dollars per quarter. So this 20 billion US dollar current account surplus for Russia, you get a sense of the scale of each economy. This is why it's so important to adjust for GDP. Here we're taking Russian current account and dividing it by Russian GDP. This is why it's important to do that, is because the size of the economy makes this number kind of much less useful. And I'll also point out the reason I did it in dollars is there's a lot of volatility with the ruble, as we will see when we take a look at asset markets in a second. So here is disaggregated GDP. Currently, annual Russian GDP is running about 240 trillion rubles per year. Now, much like the US, a large component of their GDP comes from services, 56%. Now, this also does include defense, and we'll take a look at that specifically in a second. Manufacturing and utilities and mining, unlike the US, make up a large share of Russian GDP. About 30% of Russian GDP comes from manufacturing, mining, and utilities. Here we can see that reflected in the white line, the green line. These are seasonally adjusted numbers, so there's some volatility. The other thing that I think is interesting that should be pointed out, much like the rest of the world, there has been an increasing share of GDP coming from what's called government administration. This is very similar to the video we did on the UK a week or two ago. And it's also very similar to what we started to see under the last administration here in the US, which is a rising share of GDP coming from basically the government just being more creating more government agencies and spending more money on kind of bureaucracy. We can see that in 2022, this made up about 2.1 trillion rubles per year came from this kind of government bureaucracy. Well, it's increased significantly to 2.8 trillion rubles. Now, again, this is a common story. This was the case under the last administration here in the US. It was also very pronounced when we looked at the UK. So clearly, if we're talking about kind of disaggregated GDP, we're talking about Russia, you got to talk about energy and oil. So here's Russian exports in ruble terms. Now remember, 60% of Russian exports are energy related. So we have to look at the oil price. And again, we're looking in ruble terms here at the oil price. President Trump has made mention of this many, many times that the best way to get Russia to end the conflict in Eastern Europe, kind of gain leverage over them, is a lower oil price. Well, we can see that reflected in revenue that is coming into Russia from their exports. We can see here that when the oil price was spiking in January or the end of last year, it wasn't spiking nearly as dramatically as we saw, say, in 2022, but spiking nonetheless. This brought the revenue in ruble terms down from 4.3 trillion rubles down to 2.5 trillion rubles. So this is a significant decrease. When you get that lower oil price, this is a significant decrease in the amount of revenue that is going into Russia from selling energy and energy-related components. Now, one thing President Trump doesn't ever mention that is important to keep in mind is the exchange rate. If the ruble were to strengthen dramatically versus the dollar, just as an example, it would make this oil price decline and therefore the decline in revenue much less significant. So one piece that Trump always kind of leaves out with the oil price point is the exchange rate. Now, we can see that the ruble has weakened going back to the early 2000s quite significantly versus the US dollar. I will note that the ruble has strengthened over the past quarter or two. We'll get into asset markets in a second. Here's military expenditure. Again, disaggregated GDP, everything that's going on in Eastern Europe. We got to talk about this. So, in US dollar terms, on an annual basis, Russia's spending about 150 billion US dollars per year on their military. Now, for comparison's sake, in the US, we are spending about $1 trillion per year on our military. Now, again, you have to adjust for the size of each economy to look at it as a share of GDP. This is really the best way to look at things. Military expenditure as a share of GDP for Russia is about double that of the US at 7% of GDP. So very, very significant component of Russian GDP. Here are a couple very important metrics to look at as we get into kind of the fiscal health of Russia. Here we're looking at GDP. This is real growth on a year-over-year basis. So here we can see 1.4%. That means the Russian economy in inflation-adjusted terms is growing at 1.4% every single year at the current rate. Now, the white line shows the inflation rate, again, on a year-over-year basis. Their inflation rate is quite high at 9.4%. This is common with wartime economies, as we'll take a look at when we get to the yield curve here in a second. They have pretty high inflation and high rates as well to counteract some of that inflation. Now, real growth, however, has been rolling over. Going back the past 2 years or so, we can see that they had pretty significant real growth, inflation-adjusted growth of about 5.3% for about a year here from 23 to 24. Well, that's been rolling over, and their real growth has been declining. They're still growing, but they are growing at a much slower pace than they were just a year or two ago when their real GDP growth rate was 5%. Now, of course, we also have to look at the cost of the debt relative to what's called nominal growth. So, nominal growth, we're taking that real inflation adjusted growth and we're adding in inflation. Once you do that, Russia has a nominal growth of 10%, or actually closer to 11%, 10.8%. And you have to evaluate the cost of the debt relative to that nominal growth rate to get a sense of how debt burdened a country is. Um, as long as you can keep nominal growth above the cost of your debt, the debt burden is not so significant. But when the cost of your debt is above the nominal growth rate, that's when you start kind of getting this increase in the debt burden for you. We can see that that happened a couple years ago. Their 10-year yield, or the interest rate or the cost of their debt, rose above their nominal growth rate. Currently, their 10-year yield's 14.8%, and their nominal GDP is only 10.8%. Now, as we'll see in a second, they are not nearly as debt burdened as the US. But it is important to note that as the cost of the debt rises above nominal growth, which really arguably you could say has been going all the way back to the summer of 2022, when the cost of the debt rises above your nominal growth rate, that is when the debt starts to become an issue. Clearly, they have high inflation still of 9.4%. Here's the bond market and the yield curve. And there's a couple main things to look at here. Here in white is inflation. We're just taking a look, quite high, 9.4%, common during a wartime economy. And then we have the kind of yield curve as we normally display it. The shorter durations are the lighter colors. So in yellow, we have the 1 year. In orange, it's kind of light orange color, we have the 2 year. In this kind of darker red, we have the 5 year. In green, we have the 10 year. And in blue, we have the 20 year. This is the longest duration that I was able to find for their bond market. Now, it's important to look at the shape of the yield curve. We can clearly see, oh, by the way, and then in pink here is the central bank interest rate. This is their equivalent of the Federal Reserve, that overnight short term interest rate. But you have to look at the shape of the curve. So we can see that they have had real positive rates, right? The interest rate on their debt has been above inflation. Meaning again, this is a increase. This is a negative if you're looking at, say, debt burden. You want to, if you really are worried about the debt, you would try to keep the interest rate below the inflation rate. This is how you inflate the debt away, as people say. Generally, it requires central bank buying of treasury bonds, or in this case, Russian government bonds. Generally, the bond market will not allow you to have negative real rates. But as we can see, they have been positive going all the way back to 2023 at least. You can see the cost of the debt across all the different maturities is above the inflation rate. So this is and significantly above, 3, 4, 5% above the inflation rate. This is that positive real yield. When people talk about real yield, that is what they're talking about. Now, it's also important to look at the shape of the yield curve. And something very interesting happened here, very similar to the Italian video that we did on the Italian debt crisis. They have a deeply inverted yield curve. What does that mean? Here we're looking at the 10-year yield minus the 2-year yield. And this dotted yellow line represents 0%. It is one scale for all of these different metrics. One scale over here on the right. Dotted yellow line is 0. Well, what we can see is that generally you would expect the longer duration debt to have a higher yield, or what's called a positively sloping yield curve. You can see the purple line is above this dotted yellow line. That is when the yield curve is shaped normally. Now we can see there's a lot of volatility, especially at the short end of the Russian bond market in terms of yield. So it can be a bit busy to try to evaluate the yield curve with all the different yields displayed like this. So you can take just the difference between the 10-year and the 2-year. This gives you a general idea of the shape of the yield curve. And what we can see is that it is deeply inverted. And the reason this happens is if investors are worried about the solvency or the health of the government over, say, the next 1 year, because there's a major conflict and maybe funding that conflict is very expensive. Maybe you're worried about political volatility and you're worried about, is this government even going to be around in the next 1 year, 2 years when it comes time for them to pay my bond back? You're going to demand a higher interest rate on those shorter duration bonds. This is kind of the opposite of how it generally works. Generally, if you're taking duration risk and buying a 20-year government bond, you would demand a higher interest rate. Well, when it's inverted, when the yield curve is inverted, as we can see happened all the way back in 2023, when that yield curve inverts, what is happening is investors are selling the short term bonds and buying the long term bonds because there's much more kind of stability in those longer term bonds. Now, this also generally corresponds to a rate hiking cycle. As we can see in pink, the central bank interest rate here in April of 2023 was about 7.5%. As they hiked rates, the short term bonds sold off the hardest. So their yields rose the most. That is how we got this inverted yield curve, as we can see here in this kind of dark purple color. Now, it's important to mention inflation had bottomed here in May of 2023, and this was when the interest rate was about 7.5%. Inflation had bottomed at a pretty manageable 2.2%, but then it started to pick up 3%, 4%, 5%, 6%, all the way up to 7.5%, forcing the central bank to raise interest rates, raise that overnight central bank interest rate from 7.5 all the way up to 15.5, 16% by January 2024 to control that inflation. Well, again, generally what you will see is short-term bonds sell off quite hard, and you get inverted yield curve as we were talking about down here. Well, the other important thing to mention is the yield curve actually uninverted just a couple months ago, here in June or July of 2025, of the current year. That when the yield curve uninverts, this is generally actually when generally an inverted yield curve, by the way, forecasts or could even cause a recession. When people talk about that dynamic, it's important to mention that when the recession actually happens is generally right after the yield curve uninverts. Well, it uninverted and went positively sloping again, back again in kind of, early to mid July of this year. We can see rates have been moving sharply lower. Again, this is expecting lower inflation, lower nominal growth, and a lower central bank interest rate. Well, if things were to come to an end, you would expect inflation to fall. You would expect the central bank interest rate to fall. You would expect all nominal growth in its entirety to fall. So the fact that bond yields have been moving so sharply lower over the past month or two, this is kind of when peace talks really kind of started to develop, started to get pushed really hard, at least on the U.S. side. It appears the bond market is starting to price in the likelihood of actual end to the hostilities, and that is reflected both by the fact that all rates are falling, but short-term rates are falling the fastest. This is called a bull steepening, and we can see that it uninverted the yield curve. So both of those kind of indicate to me, at least, that the bond market is pricing in an increasing likelihood of an end to hostilities. Here is that ruble to dollar exchange rate. Here we're going to look at it, some asset markets. The first one to look at is, of course, the currency versus the dollar. We can see that going back to the early 2000s, the ruble has been weakening versus the dollar. Here I will measure from 2002 up until now. The ruble has weakened by 63% just in the past 20 or 25 years. One thing that should be mentioned is, of course, sanctions were imposed in 2022, after the hostilities started. Sanctions were imposed by the US. And initially, the ruble sold off quite sharply. But the thing to remember is remember, Russia runs a current account surplus. They run a trade surplus. A weaker currency, generally speaking, if you take sanctions out of the story, a weakening currency generally encourages exports. So if you are already exporting more value than you are importing, therefore running a trade surplus or a current account surplus, a weak currency is actually beneficial for you in some ways. Now, some of that is offset by the fact that there are clearly sanctions, and the US will sanction you if they don't like you doing business with Russia. So it's not a one-to-one sort of thing, but just in general, a weakening currency, as is the case with Japan and China, for example, can actually be beneficial. We can see that when the sanctions were announced, it caused the ruble to sell off quite sharply, but then it rebounded. And if we look just from, say, 2021, before the hostilities up until now, we can see that the ruble has barely moved. So if we go right here to this, right before the hostilities started, and measure the change to where the dollar ruble is trading at now, it's only down about 6%. So the effort to kind of crush the currency, crush the economy, really bring them to their knees, it didn't have as profound of an effect as I think US policymakers were expecting. Here is the Russian stock market. And again, this is in ruble terms. So here we can see that they've been in a bull market for the past 10 years or so. But again, this is in ruble terms. So we have to adjust for the fact that the ruble has weakened substantially. So here we're looking at the stock exchange in dollar terms. We can see it's a much different picture once you adjust for the weakening currency. Here's another way to measure kind of the strength of the currency. You look at the gold price in ruble terms. So here we're looking in ruble terms, and we can see that it takes significantly more rubles to buy 1 ounce of gold just in the past couple years. So in 2022, 1 ounce of gold in rubles went from about 100,000 rubles per ounce of gold all the way up to 250,000 rubles per ounce. So that is a significant weakening in terms of the currency, in terms of purchasing power. And then finally, here is the 10-year yield for the Russian government bond. We can see their yield is quite high, 13.96%. Again, remember, yield is inverse to the value of the bond. So when you see the yield rising so sharply like this, it can correspond to selling of the bonds. And something that we saw that is important to mention, here I'm going to adjust the stock back to rubles, and then we're going to show the exchange rate. Something I want to point out is what's called capital rotation. This is when capital is invested in markets in a country, and then something happens that shocks that capital and causes it to leave. What you would see in a capital rotation environment is if you have money in a given market, you'd sell it at any price, doesn't matter. You'd sell your bonds, yields would go up because remember they're inverse. So you sell your bonds, yields go up. You sell your stocks, stock market down, and then you're left with the currency of whatever country you're in. But you don't want that currency. You want to get out of that country. So then the kind of second step is then you sell whatever that currency that you have from your bond sale or from your stock sale, you sell that local currency. That is kind of the second step or the final step. What did we see? We saw that capital rotation play out pretty brilliantly in 2022. We can see the stock market declined in ruble terms. We can see the currency declined versus the dollar. And we can see this in terms of the bond market. We can see that bonds sold off quite sharply, causing yields to spike. Now, remember, I'll say it one more time. The value of the bond is inverse to the yield. So maybe this is a better way to think of the value of a 10-year Russian bond. We can see the stock market declined sharply. The bond market declined sharply. People were left with rubles. They really didn't want the rubles. They wanted something else. They wanted out. So they sold the rubles, causing the white line to decline. Here, we're going to look at the kind of central bank side of things. Clearly, much like most economies in today's world, they have been printing money. to a substantial degree. We can see if we go back to 2021 before the hostilities, their money supply was about 60 trillion rubles. Well, it is currently 120 trillion rubles. So just in the past 4 years or so, their money supply has doubled. The central bank balance sheet in red has also increased dramatically. We can see that reflected in nominal ruble terms is currently about 65 trillion rubles. But again, it's important to adjust for the size of the economy. So in green, we're looking at the central bank balance sheet as a share of GDP. What we can see there is the Russian central bank balance sheet is about 30% of GDP. This is quite significant. It's notable for sure. The US, the Fed here for the US, our central bank to balance sheet to GDP is about 23% or 22%. So the degree, again, you have to adjust for the size of the economy. And then finally, the last metric that is important when looking at this sort of thing is debt to GDP. So this is debt divided by Russian GDP. We can see it's only at 9.4%. So when I had mentioned that the fiscal strain and the debt burden of having, we were looking at the yield curve and having the cost of the debt above the nominal growth rate, how that's an increased debt burden. But I said, it's not too much of a burden for them. This is why. It's because their debt to GDP is very, very low at just 9.4%. Now, again, for comparison, US debt to GDP is about 125%. So finally, to end here, I figured we would do some of our calculations that we do for our silent depression sort of videos. Here we're looking at the unemployment rate, same unemployment rate we were looking at before. This is, for the average Russian, indicating pretty substantial health in terms of, what is daily life like? Well, here are wages. And this is in nominal ruble terms, and it's a monthly figure. So the average Russian per month makes about 100,000 rubles per month. But again, going back to all the silent depression work we do for the US, it's important to adjust for things like GDP. So here we're taking a look at wages in nominal terms in red. And then in blue, we're taking a look at wages divided by GDP. Because remember, what you want to see, it does you no good if GDP is growing at 8% a year, but your wages are growing at 1% a year. Well, you're not really benefiting from this massive economic boom, right? So you take wages and you divide by GDP. This shows you the relative growth rate of wages relative to the growth rate of GDP. And what we can see is that if the numerator is increasing faster than the denominator, this blue line will go up and to the right. And sure enough, wages have been outperforming GDP. This is the exact opposite of what we see in the US, where wages have underperformed GDP. But it's not such a happy story. Once you look at wages as a share of the M2 money supply, this indicates kind of a real purchasing power of those wages. And we can see that that has been declining going back all the way to the start of the data in the 90s. So unfortunately, for the average Russian, while their wages might be increasing faster than GDP, their country's GDP, their wages as a share of the total money supply it has been falling, meaning the money supply has been increasing faster than their wages, which is why this purple line goes down. So hopefully that was helpful. I do think that there's some amount of leverage. We could see really, the real GDP, the real growth rate has been falling, rolling over, falling for the past couple years. There is certainly a strain on the Russian economy to finance the conflict in Eastern Europe. Lower oil prices certainly are helping to bring some leverage to the table. But again, you have to remember the exchange rate. It's always important to look at that exchange rate. So anyways, hopefully that was helpful. The bond market does seem to be pricing in a likelihood of an end to hostilities. Whether that comes from this particular summit, I'm not sure. I think most people out there could hopefully agree that an end to armed conflict is always a good thing. So I guess we can hope for that. But the bond market is pricing in a likelihood of an end to hostilities, at least from the way the data looks to me. So anyways, hopefully that was interesting. Hopefully that was educational, and I will catch you in the next one.